back in 2010, something was launched called the East London Tech City by the then Prime Minister, UK Prime Minister David Cameron. The idea was to take vacant property, underutilised talent from the local area and finance from the city to try and create effectively an incubation zone for small disruptive startups. That was really then the start of what became Tech City, which is now Tech Nation, and it's the real primary focus of the government to try and get disruptive businesses off the ground, aping what has been seen on the west coast of the US. So if you're a business at that time, a startup at that time, if we look at a good old standard pestle analysis, back in 2010 we had a pretty peaceful position. There was low interest rates, inflation was within the 2% margins. The internet was just exploding, mobile phones were exploding, more digital connections. The world was going mobile, so the technological forces are great, lots more developers, lots more energy, lots more money. From an environmental point of view, the world got smaller thanks to cheap flights, so it was easy to communicate with everybody. And of course, globalization was enabling things to carry on. We were still part of the European Union. It was a very strong place. There was no borders. And so the attitude very much back then in 2010 onwards was, come on, let's go, let's do it. Nothing can hold us back. The world is ready for disruption. And that's pretty much what happened. So that continued on a pace for the following 10 years. And then what happened in 2020? The world got hit by a pandemic that it had never seen before. Everybody started to panic very quickly because we were thinking what's going to happen. But then the governments came to the rescue. Here's a chart that just illustrates what happened. So this is the Federal Reserve in the US's balance sheet between 2005 and 2022. If you look around the period of quantitative easing that was put in place after the financial crisis of 2007-2008, obviously the money supply increased, and actually when you look at it towards the end of 2019, things were starting to grind to halt. They were talking about ending quantitative easing, interest rates to rise, and then therefore applying brakes on the economy. However, when COVID hit, that meant that there needs to be more stimulus, and you can see here that the money supply in the US and of course around the world, in the UK and in Europe, massively increased as the governments around the world were offering loans, offering finance, offering all sorts of support, furlough loans, C-bills in the UK, and therefore the presence of money in the economy was massively increased, enabling people to carry on with what they were doing and ideally doing well, or at least surviving through the pandemic period. But in fact what happened, and maybe an unintended consequence, we don't know, was that the price of money was so cheap that then it was very, very easy to raise money for VCs. And if we look here at the current position, this is only a few weeks ago, about the number of VCs just exploded, and private equity firms and people pushing money into effectively bets of startups and disruptions. If you look at this chart here, you can see the detail. Not only do you have these companies who are putting in billions and billions of rounds. I mean, Excel has done 1,831 rounds, which is just a phenomenal amount of investment. But actually another number on the top left there is 151,000 investors. So that's 151,000 venture capital businesses, private equity businesses, and most of those have come in the last 10 years. It's a phenomenal amount of money that's now being pushed in, or has been being pushed into disruptive businesses. The question is, how can that carry on? If we take another look at the spread of this investment, you can see that it's really come to a crescendo in 2021 with a deep red line, with, in the UK alone, 38.4 billion of investment compared to the rest of Europe, which is over twice as much as in 2020. It's an absolute phenomenal growth. And of course, what they're all chasing is the exit. So whether that's a trade sale, whether that's a large group with profitability as a standalone, or most likely to be a form of either full or partial IPO on a listed market, that's really the kind of golden vision for everybody, the pot of gold at the end of the rainbow. And you can see that recently, or most recently, prior to 2022, these IPOs are getting larger and larger and larger. Obviously the Facebook, the Uber, the lift, the LTs and Twitter that happened over the last few years have been the sort of like the catalyst and the goal that everybody's chasing. And then you had Snowflake, Airbnb, DoorDash, all coming to the market, all making their founders and VCs pretty wealthy at the point at which they floated on the markets. So you can see that in the last few years, that really has accelerated. And in order to get there, you have to be considered something called a unicorn, something that's very unusual and you don't see very often, and it's just basically a single player within a marketplace that's regarded to be the one that you have to put your bets on. Now, of course, unicorns by their nature are supposed to be pretty rare animals, but if you see from this chart, this is both the number of companies that founded since 1990 with a 1 billion valuation. You can see that the numbers of these are just accelerating and have accelerated over the last few years, pretty much because they are being pumped full of money. They can buy their turnover, and then they're being considered very carefully. Not very carefully. They're considered for an IPO. So that's really where we stood at the end of last year. However, towards the middle to the end of last year, these are the kind of comments that people were saying. Initially dismissed as tall poppy syndrome, or some reason that people were unhappy that they weren't part of the business that were floating. But as this headline shows, today's unicorns have bigger cumulative losses than Amazon, lost money far longer than Amazon, and there's still no turnaround. So it's almost like they forgot about the hockey stick being where you lose money for a bit and then eventually you start to make money. Many companies were starting to think, and many investors, especially public investors, were saying, hang a minute, this is crazy. Growth is all great, but at some point you have to show that you can be a sustainable business. And that's where the doubt started to set in, and that's where the problems have been seen recently as the interest rates have started to creep up, and people are questioning the business models and viability of some of these companies. And that brings us to 2022, which some people are calling the Icarus year, where they're seeing businesses that have done previously super well and flown very high. But now, is it too high? Is it too far? Is it too hard? And is it too fast? Now let's look at the pest analysis for 2022. There's war in Europe, we have Brexit, we have inflation, we have had a pandemic which we're still going through. There's lots of negative influences around social media, there's lots of negative commentary about it. People are trying to get off their device addiction that they may have found themselves in over the last couple of years. We have a lot of activity and action around sustainable businesses and global warming and climate change. Lots of negativity around doing the right thing, or positive about doing the right thing. And then we have data protection and data privacy. So a lot of digital businesses are finding it difficult to preserve privacy, and it's also becoming a lot more expensive to reach your market. So the go-to-market strategy now is not as economic as it used to be. And so people are looking at each other and saying, oh shit, we're really screwed. We've got a problem here. What are we going to do? Here's another slice from the Sequoia note to portfolio companies. When capital was free, i.e. interest was very low rates, everything was cheap and easy to get funding, the best performing companies were capital consumptive, i.e. they could work at a loss and they could grow very fast. As capital has gotten expensive, these have become the worst performing companies. And what are the other implications of capital being expensive? Given every dollar is more precious than it was, how are you going to change your priorities? That's a very strong message saying, guys, you need to really pull back and work out how you're going to get back into a very profitable position as soon as you can. So in 2022, reality is really starting to bite. That cash reality. The inflation is tightening. So if you have debt, it means that you're going to be under a lot more pressure to provide money to service that debt. If you are selling to consumer businesses, then you are going to have issues around the cost of living crisis, supply chain issues. There's many things that would be headwinds to your business right now. And if you're on a cash runway, that makes things much more urgent and difficult. A few weeks ago, Sequoia Capital issued some guidance to their portfolio companies. They're basically calling this what's called a crucible moment, where things are changing from one state to another. They've basically said to everybody, listen, the focus is now shifting away from loss-making companies to companies with profitability. And if you can see this chart here, it shows you that the tech index in terms of the performance of the businesses listed on the markets, if they're profitable and unprofitable, the stocks obviously are holding up slightly better for those that are making profits as opposed to those that aren't. It's a massive bellwether, and it's something that everybody has to really put at the front of their minds right now. And of course, as we see with many other changes of market conditions which precede a crash or any kind of negative reaction in the market, of course the commentary starts to go the wrong way. So the gig economy, so people who are used to servicing takeaways or discretionary spending around transport, they're suffering. You can see these comments here. The valuations are changing. Eric Paley there talks about the era of indifferent capital. That's basically capital that goes in and they think they're basically putting it in as a bet rather than helping a company to grow and expand. Only this week, Klarna has been seen to be having difficulties about raising, based on their previous valuation of 47 billion. It now looks like it's going to be around 10. It could be as low as 6 billion, where they're raising, effectively selling 10% of their business just to keep going, in theory. And then Fred here saying the nightmare scenario for agency funds. If you're raising money now, it's very unlikely that those early stage investors are going to get included in the next rounds of funding and the next round of shareholdings. So, you know, there are lots of negative sentiments around. It's a tough time for a loss-making business, especially if they're heavy with staff and heavy with tech investments. And of course, what does that bring? Unfortunately, the quickest and easiest way to reduce your costs is to look at your headcount, look at your staff, and pull back very clearly. And we can see here from this chart, in terms of the layoffs from tech businesses and venture capital businesses, there was a big jump at the beginning of the COVID pandemic, and then it flattened out because of the government support. And then we've obviously seen this year, Q1 and now Q2, it's accelerating. Companies are starting to really think about what staffs they need, which countries they need to be in, and really focusing down on the stuff that will bring them to profitability rather than the heavy bets. So if you go back to the secure memo that they sent to their portfolio companies, these are the strategies that they basically laid out for them. Simplicity scales, complexity doesn't. So it's basically saying, stop investments in your longer bets, go for the stuff that you know works, and then obviously scale that with simplicity. Speed is one of the greatest business strategy. If you can move fast, you can move first. Double down on your top talent. So that means, you know, continue to hire great people, but obviously make them bring as much as they can to the party. You have to align about your agreement in terms of what you're doing. You have to very much tighten up your value proposition to drive sales. You have to stick to your knitting. That's usually the best way through tough times. Just don't differentiate. Stay doing what you know works. And if it's not one of these things, it's a complete waste of time. If it's not driving growth, if it's not saving you money, and it's not reducing risk, it's just not worth doing. And this final slide actually takes a slightly different view. Even though the sentiment is really driving towards profitability, you can see from this chart that plots the amount of dry powder. Dry powder is effectively money that's been raised by investors but hasn't been deployed. And you can see here at the end of 2021, there's $3.4 trillion that are sitting awaiting to be invested. Now, obviously that's good news, or it's not such terrifying news if you're a venture capital-backed business. But on the other hand, they are going to be very selective because it's not guaranteed to when they can keep those going. And I'm pretty sure that number is going to go down fairly quickly as the interest rates rise and people will find other places to put their investments. So in essence, is it all over for the disruptors? Of course, the answer to that is going to be no. But the key message right now for the next 3 or 4 years, as we go through these tough times and as the availability of indifferent or cheap capital dries up, it's very important that people who are attempting to disrupt a market or industry or a set of companies stay as agile as they possibly can. They shouldn't have to go off in all sorts of different directions. They shouldn't be going to new markets. They shouldn't be launching new products unless they absolutely have to. It's not the strongest of species that survive, nor the most intelligent, but the one most responsible to change. We will see many changes over the next 4 years, as companies come and go, as industries do well, whatever happens with the war in Europe. There are many, many things that are going to be thrown in our faces for the next few years, and it's very, very important that we stay strong, stay agile, and stay positive. Thanks very much for listening.